More now on the surprise October payroll numbers. What does it mean for investing in bonds? We're joined now by Janis, Senior Portfolio Manager at MFC Global. He helps manage $5 billion in global bonds and currencies. Many of his funds beat out about 90% of the competition. So, Dan, this surprisingly better than expected jobs figure this morning, does that make you avoid Treasuries, a seller?
Yes, I still, the number was a surprise. As a bond guy, we're cynical by nature, but we like the fact that the number beat expectations, and it's a start, I think, of hopefully some good news in the future. And as such, I think the market will focus on risky assets, predominantly high yield and maybe some emerging market locations, together with maybe looking at some non-dollar situations. So I would, avoid Treasuries right now because in a relative risk reward, they don't make sense.
But that's been your view for a long time, though, right? Before this morning. Talk to me about where you are finding opportunities around the world.
Sure. When we look at the Asia-denominated countries, Indonesia, Korea, Singapore, and Malaysia, we're getting some bond appreciation there on some credit situations, together with potential currency moves as China unlocks the value of their currency. And then when we go to the U.S., in not necessarily specific industries, but in the high yield market where we're comfortable with management, they have the ability to roll over their debt, whether they have good bank relationships and market ability to issue bonds. We like those situations where we're clipping a coupon between 7 and 9% with some total return possibilities in the 10% range. Another area is in some of our Build America bond in the U.S. bucket. We're looking at that as maybe a 2 to 5% weighting, where even though they're longer duration bonds, not necessarily are they priced efficiently. We can take advantage of the mispricings there with a higher quality with 6 to 8% coupons that make sense to us.
All right, so there are still some opportunities here at home, but talk to me about overseas. How comfortable are you, given the kind of skepticism we've heard from Brazil, from China, from German ministers there saying that they question the U.S.'s decision to go ahead with quantitative easing? Are you apprehensive when you put money to work overseas that you're going to see more capital controls and that it's just going to get more expensive for you to invest?
Well, there will be concern when you look at the rate of change of some of the currency moves. I'm not sure if we're at that point right now. We think there is still more room to go, but that is a concern when I invest. But I have to go where the growth is. And when I look at the Asia bloc, a 6 to 11% growth, depending on which country you're in, does make sense to us, especially when you're looking at a structural change from economies going from export-led to domestic-led, and we think that's a 5 to 7 year probability. You should see a good currency kick on a 3 to 5% appreciation there. So
you'd still be buying into a Brazil or a Thailand right now?
Well, Brazil is a different animal. That's Latin America. We did have a significant appreciation of the currency from 2 maybe down to 170. There is some value there left, probably on the spread on the bonds, because you are getting 9 to 11% returns there. The currency probably will be in a range maybe a little bit stronger, but the outperformance on the currency, I think we've seen those days.
All right. Thank you very much for joining us this morning.